This is the Stuff About Money podcast. I am your host, Erik Garcia, certified financial planner. I am flying solo without a co-host. Xavier is out sick this morning, but we have a guest on our podcast this morning. Before I introduce you to our guest, what Xavier and I set out to do with the podcast was really we wanted to teach people stuff about money that they didn't teach you in school, not just like the technical, formal stuff about money, how to budget, what a stock is, what a bond is. All that's important. But one of the things we really wanted to do was to teach people to think better about money so that you can make better money decisions. So a lot of our episodes, we do talk about how to think better about money, how we relate to money, some of the behavioral stuff that's involved with money. We also do talk about some of the more technical stuff about money. In this show, today, I'm actually pretty excited for him and looking forward to it. We have Michael Laughlin on from Morningstar. So we are going to talk a little bit more about the markets. We are going to talk a little bit more about investments and the different types of investments and what recessions are and what market corrections are and how that all impacts your portfolio. So let me go ahead and introduce Mike here real quick, and then we'll jump into this. So Mike is the head of portfolio specialist team over at Morningstar. He is responsible for partnering with financial advisors like myself on capital markets, Morningstar's views and investment products, portfolio construction, and risk management. Mike leads a team that's responsible for overall strategy, client engagement, and team development. And prior to Morningstar, Mike was at BlackRock for 12 years, and he worked as a senior portfolio consultant, head of portfolio engagement team responsible for helping advisors create and maintain customer model portfolios. He's a CFA, certified financial analyst, charter holder, and also holds the financial risk manager designation. Until recently, he also volunteered his time as a treasurer and head of finance and investments for the Berkeley Humane Society in Berkeley, California from 2016 to 2022. Mike, welcome to the Stuff About Money.
Thank you, Erik. It's a pleasure to be here. I'm really looking forward to this.
So let me translate. That was a mouthful, your bio. Let me translate. You're the guy who kind of sits between us advisors and some of the market strategists and portfolio managers, and you kind of help make sense of what they think. You're almost like a translator, right?
Yeah, a translator, a liaison. We act as an extension of the investment team that speaks client, if you will.
Yeah.
And what we really help folks do is think about the market environments that we're in and, how to put portfolios together. Something that we like to say is in investing, risk is not bad, but there's a difference between intentional risk and unintentional risk. So we really try to help advisors, uncover and make sure that the exposures and the risks they're taking are 100% intentional 100% of the time.
Cool. And let me correct something. I don't want to minimize your role just as like a Google translator. You're more than a translator. You obviously know what you're talking about. So
it's an apt description of what we distill some of the complex topics into simple, easy to understand form.
Because we're all not CFAs. I would dread having to go get my CFA designation. I've looked at it. I'm like, I don't want to do that.
I got it in my mid-20s, which is a great time to get it. My girlfriend at the time, now wife, was incredibly supportive through the process. And, to be honest, while not only did I learn a lot, it probably kept me, out of some bars and things I didn't need to be in for 6 months a year while I was studying. So it was good.
Break down real quick for our listeners. What the CFP designation, which I hold as the Certified Financial Planner designation. What is the CFA designation, and what does that entail?
Yeah, so CFA, it stands for Chartered Financial Analyst. It's a 3-level course, if you will. So level 1, level 2, level 3, focusing very broadly across the investment landscape. So it's really multidisciplinary. You learn about accounting and balance sheet and income statement analysis. You learn about equities and fixed income. You learn about portfolio management. You learn about economics. You learn about alternatives and derivatives. There's probably 1 or 2 sections I'm actually even still leaving out. I would say what makes it challenging is its breadth. But it's such a great, at least for me, it was such a great way to learn how to think about investments from just an incredibly broad landscape.
Yeah, breadth and depth. I mean, it goes pretty deep.
It does. Yes, it does.
Yeah. All right, so let's hop into this. All right, Mike, what's one thing about money you know today that you wish you would have been taught in school?
So, I'll take maybe more of a qualitative route to this, and I love the question. To me, I think it's investing, like true investing, is a great way to build wealth slowly, and not a great way to build wealth quickly, if you will. And I think, especially coming out of school, that maybe wasn't the exact expectation I had, but I've learned through time, the power of compounding, and how you never really want to interrupt that if you can avoid it. But that is one of the most powerful forces, in wealth creation, and sort of just like having a plan, sticking to that plan, trying to avoid the emotional biases that can knock you off your plan, and just remembering I'm in the investment realm for the long term, has been actually pretty helpful to me in my personal accounts over the years.
So interesting to me. It seems like the smarter someone is, the simpler their answer to that question is. Right? It's like we've been around, we've seen everything, and at the end of the day, it comes back to it's like an ancient wisdom: wealth made hastily dwindles, but whoever gathers little by little keeps it.
Yes.
Right? Wealth is built over time.
Yeah, and it helps me at least remember it's okay to have a view on the market, or to think something is attractive and to invest in that thing. I just try to make sure that the sizing of some of those investments that I make is appropriate relative to my long-term
Yeah.
portfolio. I mean, the most important thing is to stay in the game. So you don't want to make any decisions that sort of potentially put your entire portfolio at risk for not being in the game, if that makes sense. So
Yeah.
yeah,
So like every season there seems to be some like investment du jour, whether it's
yes,
some kind of crazy new currency or some hot new trend, whether it's
AI.
AI or something. And in the conversations I know that I have, that I imagine that you might be having with advisors, is okay, yeah, it's cool, it's going to change the game, but maybe we shouldn't put everything in there. Maybe we should we have exposure to AI through maybe some of the big names already. We don't have to bet the kitchen sink, bet the farm on it, right?
That's right. Yeah. And what's also interesting is, when you do take a diversified approach to investing, it almost by definition is never going to feel great, because there's always going to be some trend that you could have had more exposure to. Um, in down markets, when diversified portfolios typically shine a little bit better, you're outperforming, but you're still down, right? So that doesn't necessarily feel good either. So it's really important, I think, overall, especially with money, which is something that is inherently so emotional, to
Mm,
really just try to keep your emotions in check.
yeah.
And it's going to be hardest at the most at the scariest times, if you will. But it's really important. I mean, so as an example, Morningstar puts out a study that we call Mind the Gap, which basically shows that investors underperform investments. And the reason for that is because people tend to time those things poorly. And so, obviously we want to buy low and sell high, but the average investor at times tends to, do the opposite. They buy high and they sell low. And a lot of that is just driven through, fear and greed and natural human emotions. But, if you can, right now, the numbers in our 2023 Mind the Gap survey show that over the last 10 years, investors underperformed investments by about 1.7%, which was
Mm,
actually about 20% of the overall return. So it's quite substantial, actually, and it's just another sort of proof point in the longer trend, or
yeah.
the academic research that shows that really you don't want to necessarily be trying to time the markets.
Yeah. Yeah. If we were able to do that, I think all of us who are in this field would probably be retired by now, right?
Yeah, I think so, and I certainly, from your seat, you might be able to confirm this. It seems like the behavioral side is more than half the battle. Is just keeping people anchored to the long term and to what really matters, which is, am I on track to reach my goal or not? Not so much, am I underperforming or outperforming XYZ market this week, month, or quarter.
Yeah, no, 100%. So you said in all that, you said it never really feels great. You talk about investments. and we're especially in down markets, and we are in a kind of market cycle where it really hasn't felt great for a really long time. And the reality is, from like a market performance standpoint, it's not like the market has like dropped tremendously. It's just like we've been in this like this season of, man, there's just bad news. It just seems like it's always bad news. It feels bad. It feels, I mean, it feels yucky, right? It doesn't even feel that the first part of this year was actually fairly good for the market. A lot of portfolios are actually positive on the year, but it just doesn't feel that way. And obviously, there's been talk of recession for the past, I don't know, year and a half, 2 years. Like I always tell people, I said, look, recession is always around the corner. We just don't know when. It's always there. The conversations I'm having today with clients were conversations that I was having, in 2020, in COVID, 2018, the fourth quarter of 2018, we get 2011. I mean, these are conversations that seem to continually come up. And as humans, we seem to forget that the market eventually recovered. So what I want to do is not necessarily speak to the specific situation, what's going on today, because by the time people listen to this, who knows what can happen. The markets could have changed. The markets could have recovered. The markets could have dropped more. But I want to talk a little bit about, recession, correction, bear market. These are some terms that are getting thrown around. And, Morningstar does a really good job of really putting out content out there that I would say educates not only advisors, but the general public. So talk to me a little bit about, like, what's the difference between a market correction, and I'm bringing that up. This is actually pretty timely because I think on Friday they announced that, was it the S&P technically entered correction land? Was it the S&P or Dow? I'm not sure which one.
Yeah.
But what's a correction? What's a recession? What's a bear market?
So I think the technical definitions of those would be: a correction is a decline of 10% from previous high. And that's about what we've seen in US equities since the end of July. A bear market is 20% decline from high. And then a recession, the technical definition, I think, is two consecutive quarters of negative GDP growth, which we're not in at the moment.
On the contrary, didn't we just have like crazy GDP growth in the third quarter?
Yeah, the Q3 number came in very hot, let's say, at 4.9%, even beating pretty high expectations for where that number could be. So the economy itself is actually in pretty good footing. And to the point that you were making, it doesn't necessarily feel great, but if you think about coming into 2023, we felt like the range of potential outcomes was pretty wide, meaning there are a lot of different paths that the market can take from here. And if you look back, here now at the end of October, we've actually probably been on one of the better paths, considering where we started 2023, that we could have potentially been on. S&P is still positive about 9 or 10% for the year. Bonds have gotten a little bit negative at this point, but all things considered, we've been in a pretty good place. And on the question of recession, a lot of folks have predicted 9 of the last 2 recessions, if that makes sense, right? So it's always dangerous to try to say, hey, a recession is imminent or coming next month, next quarter, next year. I would also maybe go so far as to say, if you are a long-term investor with a 3 or 5 or certainly like a 10-year time horizon, I don't want to minimize the impact of a recession, but from an investment standpoint, I think I would go so far as to say it really doesn't matter if one comes a month from now, a quarter from now, or a year from now. And I think you're probably likely to do more damage to your portfolio trying to anticipate it, rather than just accepting the fact that recessions are inevitable, they will come, and you just need to ride them out. But if you look at the data over, going back to the end of World War II, at different recessions that we've had, obviously 2008, the financial crisis, tech bubble in 2001, some of the recessions we had in the 80s and 70s, almost invariably, if you go 3 or 5 years out from the start of that recession, markets are positive. And that's why I say, really what you want to do is just stick to the plan, ride it out. And if it happens tomorrow or next year, it doesn't necessarily matter as long as your time horizon is reasonably sufficient.
Yeah, I was actually reading a Forbes article this morning. It's a little bit dated. It was from last year, but same idea. Again, because these stories repeat themselves.
Yep.
Just talking about how do stocks perform post recession.
Yep.
Right. So like 12 months on average, the S&P 500 has returned 16%, 12 months following a recession. 2 years after it's returned 20%. So it's fascinating. And what's interesting here is 12 months before the recession, the average is only -3. Right. So I think that supports your point. When you go to the data, when you look at the objective facts, it feels bad, but it's not. The data is not necessarily nearly equivalent to our feelings.
That's right. And the cause of the recession is always different, right? So financial crisis, tech bubble, oil shocks in the 70s. The cause is always different, but the outcome 3 to 5 years hence is essentially, or at least historically has been, always the same. And if we enter a recession in the near future here, the cause again will be different. We sort of have, two major wars happening. We have inflation. We have all of these, things that are negative that we can point to. But I at least do think that, again, 3 to 5 years hence, the outcome will be the same. It's really if you're entering retirement, or you're going to be going from the accumulation phase to the decumulation phase, those are the folks that sort of need to be most acutely aware of this, because the way you really stress a portfolio long term is you are spending down principal at the same time you have a market shock. It's hard to recover from that, or it can be hard if it happens early in the time series. Hence the phrase I use, sequence of return. But again, if that's not you or a client who's listening to this, if you again have, if the time horizons are not even that long, right? Like 5 years plus, then it shouldn't be that big of a deal.
And for accumulators, this is actually a good time to put money in the market. You're getting, it's like I'm in the market for a new car. I want a truck. This is like terrible. This is a terrible time to go buy a new truck, right? Because like you can find them, like Ford's on strike, everyone's on strike, so everything is going to go up. I do not want to go pay a premium for a truck. I want to wait till the end of the year or till they start producing more and they're on a discount. It's the same thing with the market. The market is on a discount, right? It's like the Macy's 1 day a year sale. Who wants to pay full price for anything?
That's right. But again, it never feels good. And
that's the problem.
That's the challenge. And but it's also why, working with an advisor like yourself, especially somebody who has, the CFP designation, or who's, really spent a lot of time studying, financial planning. This is why it's really important, because you have a coach, or you have somebody who's alongside you, helping you to not make, some of those, again, the emotional decisions that cause investors to underperform investments.
Yeah, 100%. So I was actually at a conference here, and I'm looking up one of my notes, because I thought it was absolutely 100% relevant to what we're talking about, and I can't find it right now. So I'll probably come across it at some point. Oh, here we go. This was Michael Kitces said this, who's a very prolific content creator in our space. He said the future of financial planning is not about dispensing expert financial advice, but helping clients engage in financial behavior change. And that's really a lot of what we're talking about.
Yes.
Is the difference between dispensing financial advice. We obviously need to do that. Our clients need advice that's real specific to their situations. We also recognize that as humans, we're subject to our emotions, and our emotions are driving a lot of our decisions, even when they don't make sense. So to your point, the value of having someone alongside of you who knows your financial situation, who doesn't have the same emotional investment that you have into it, who can speak from the outside and give advice in terms of, hey, that doesn't jive with what you're telling me really matters to you. That's an inconsistent decision with your value. So in a lot of our conversation or email exchange leading up to this, you kept referring to a concept that you and your team talk a lot about. It's, what is it? Prepare, don't predict.
Yes.
Let's unwind that a little bit for me, because I think it's really relevant to what we've been talking about here.
Yeah, absolutely. So just to give a little background, Morningstar, from an investment standpoint, we are really research-driven, fundamental, value, long-term investors. And the concept of prepare, don't predict is really, I think, starts with humility, to recognize that, putting a point estimate on the S&P, or putting a point estimate on inflation, or saying a recession is imminent, is maybe actually not even that useful to building a portfolio, but B, something that at least we don't feel we're going to have an edge in over short time periods. And so what we actually try to do is build portfolios that are robust to multiple different market environments or multiple different outcomes. And then as time passes and those outcomes reveal themselves in a way, we continually update, we continually tweak, we continually tilt. But we never say, okay, we're going to be in a high inflation, low growth regime, and that's how we're going to build our portfolio. We look at sort of the range of potential regimes that we could be in, and we try to build a portfolio that is robust to multiple of those regimes.
And by regime, you mean like economic, like
Yeah.
the situation? What's the economic environment look like?
Yes. Yeah,
Okay.
exactly.
Yeah.
And economic environment is one example. There are other examples. So we're heading into 2024. It's an election year. Elections are good examples of this as well, where if you think back to the presidential election in 2016, or you think about something like Brexit, you have this very discrete event that everyone knows is coming, but it is very difficult to actually accurately predict the outcome of those events. And so from a portfolio management standpoint, what we try to do is actually not predict the outcome of discrete events like that, but more, it's almost like we have a portfolio for scenario A and we have a portfolio for scenario B, and the event happens, and then we go to the portfolio that correlates to the correct outcome of that event, if that makes sense. But trying to predict the probability that a specific thing is going to happen is quite difficult, even something that is coming, like an election.
And here's what's interesting about elections, since you bring that up. I've had conversations recently. I was like, oh, it's an election year, the market's going to be bad. Well, historically, election years are actually positive markets.
Yes.
Like 12, I think, to the point of like 12% up during an election year on average. That on average means, right, in 2008, it was down 37%.
Right.
Right. But in 2020, it was up, 15+% or somewhere around there. So who knows?
Right, exactly. And that's a great example of where you don't want to head into an event like that or a year like that with the assurance in your mind that, hey, the election's going to be ugly, markets are going to be down, I'm going to move a bunch of my portfolio to cash, and then the opposite is certainly potentially possible, if not actually likely, based on some of the historical data. So
or even stuff like if a Democrat wins, market's going to be bad. Or if a Republican wins, market's going to be good. Well, that's not really what the data says.
Right.
I mean, the data doesn't say that. So it's very difficult. And I actually appreciate when you talk about having humility, right? Predict,
yes.
Don't prepare. It starts with humility. It starts with, I don't know what the market's going to do tomorrow. Who predicted, Israel and Hamas going to war? Who predicted all these things? Now, I'm sure someone out there predicted, like you said, someone predicted 9, the last 2 wars, 9 of the last 2 recessions. There's always someone predicting something. Someone's always going to be right. But my question would be, how often are they wrong?
Correct. Yeah. And that's the tongue-in-cheek aspect of the 9, predicting 9 of the last 2 recessions is, yes, eventually there will be a recession and you will be right. But, the previous 7 times that you said that, it didn't happen. And it's, overreacting your portfolio to those types of, mental, let's say, mental overconfidence that a specific scenario is going to play out. That's where people get themselves into trouble. It's also, I think, as humans, we're not necessarily wired to like understand or interpret probability
Mm-mm.
maybe as intuitively as we should. Even if I said to you, I am 80% sure we're not going to have a recession next year, like 20% is still a real number, right? Like
Yeah.
we sort of discount that to say 80% equals 100%. And no, right? Like
You
those
say, I
tail
don't know.
events.
Like,
Yeah.
I don't
And
know.
right. And I'm obviously making those numbers up, but the point being, right, like tail events happen. And so you don't, this is where, like, again, from a perspective of humility, we try to say, hey, we don't really think we're necessarily going to be good at predicting when these things are going to occur. What we do actually think, though, we will be good at, and this is where we do things like stress testing our portfolios for different scenarios. What we do actually think we have a reasonable edge in is understanding kind of the impact of these different scenarios as they play out and tilting the portfolios to respond or to take advantage of those scenarios. But we're never really ever wholesale in one specific scenario, if that makes sense.
Yeah, you're not placing big bets.
Correct. Yeah. And, especially in a market environment like this, where, if you think about the conversation we've been having, there's positive things that you can point to. GDP growth is really strong. There's negative things you can point to. We have wars, we have inflation. So what I would characterize the market environment that we're in right now is one that has a high degree of uncertainty. And
Mm-hmm.
when I say uncertainty, it again means that just the range of outcomes from where we are today is wide. But that is different than than being negative. It is different than being bearish.
Mm-hmm.
And so from a portfolio perspective, what we think the right response to an uncertain environment is to take smaller bets. So if you were to look at some of our multi-asset portfolios, we're a little bit closer to our benchmark in this type of a market environment. Now, that doesn't mean we're not exposed to things that we do like. It doesn't mean we don't have views. It just means that, again, with a degree of humility, when the range of outcomes is really wide, you typically don't want to stick your neck out super far in either direction. You just want to take smaller bets. So, if we were talking about our 60-40 portfolio today as an example, we're basically running that at 60-40. We're not leaning
So
into equity
60% equity, 40% bonds. Traditionally, that's been the kind of long-term
bellwether. Yeah,
yeah, like this is the portfolio you want to be in for, when you retire for the rest of your life.
correct.
Maybe not for an accumulator, but like, hey, I'm hanging it up. I'm not earning money anymore. 60-40 is a fairly, I don't want to use the word safe, but historically a portfolio that's historically going to provide income for you for a really long time.
That's right. Yeah. And so we
Yeah.
are just really trying to keep the ball down the middle of the fairway. Again, I mean, we're expressing some views in that portfolio, but, relative to the sizing of some of those things previously, we're just trying to take smaller bets.
So it's almost like I've had conversations with people before about, hey, what do you believe about the market? What do you believe about the market? And I'll share my thoughts. And they almost like, well, you don't believe anything about the market. I said, no, I have some really strong opinions about the market. I just don't hold them tightly. I have like an open hand. Like I believe in the market long term. I do not believe the market's always going to go up. Like there's certain things I like, certain types of investments, but I'm not holding on to them too tightly. That's when you get into trouble.
Yeah, and I'm sure from your seat sometimes, in 2022, your benchmark was probably cash, and in 2023, your benchmark is probably NVIDIA, right? In the minds of clients.
I mean, minds of clients, yeah, right.
But yeah, no, I think that's well said. We're really just sort of. It doesn't mean that we don't have views. It doesn't mean we're not trying to add value to portfolios, but at least in our opinion, that's the correct response to a wide range of outcomes. Is you just take smaller bets until those outcomes start to reveal themselves a little bit more through time.
So this leads me to the next thing I want to talk to you about, because Morningstar has kind of become known for the style box. So a lot of our listeners probably won't know what I mean by the Morningstar style box, but I bet you if you go open up your 401k, if you go log in and you're looking at investments to choose, I would say 6 or 7 out of 10 of you are going to see this little box with a grid with 9 little boxes in it. And then the particular portfolio, even if it's not a Morningstar investment, that particular mutual fund or ETF is going to, one of those little boxes is going to be is going to be colored in. And tell me a little bit about the style boxes, what those mean, because this really kind of gives us some insight into diversification, which is part of preparing.
Yes. So Morningstar as a company, our roots in the 80s are really as a research and data company. That's how we got started. Obviously, we manage investments now ourselves and have been doing so since 2001. But going back, that's our roots. And so the style box is born out of that early work. So you're right. It's a 9 box. It's a 3x3 grid, and it's essentially values, core, and growth in the verticals, and large, mid, and small in the horizontals. And so each of those boxes correspond where they intersect. You can have, mid-cap growth stocks, or you can have, large cap value stocks. And what it is an attempt to just understand the characteristics of, in this case, the equities that you have in the portfolio. Without getting too technical, essentially the way it works is on a monthly basis, all stocks are sort of like categorized, and on the dimension of value, core, and growth, the inputs are things like historic price to book, price to sales, price to cash flow, dividend yield, forward price to projected earnings. On the growth side,
those are some really good CFA metrics right there.
Yeah, exactly.
Right.
On the growth side, it's sort of, sales growth, cash flow growth, long-term earnings growth. And so it's a way to categorize companies based on those attributes. And essentially, not always, but you can think of about 1/3 of the market cap ends up in value, 1/3 of the market cap ends up in core, and 1/3 of the market cap ends up in growth. And then the large, mid, and small, there's no set like dollar amount market cap breakpoints, if you will.
Mm-hmm.
Essentially, roughly 70% of the market cap is classified as large, 20% as mid, and 10% as small. It tends to be companies with a market cap above 10 billion are large, 2 to 10 billion is mid, and under 2 billion is small. But again, those are not formulaic written into the process.
I generally say if you're looking at that box, the very top line, those are large companies. I typically will say large companies. If you look at your portfolio, you've heard of 5 out of 10 of them, 6 out of 10 of them. They're names that are familiar to you.
Correct.
When you get to the mid cap level, you probably only know 1 out of 10 or 2 out of 10. And then when you get to small cap, you generally don't know any of them.
Right.
And the general trend is the bigger the company, the more, I'm doing air quotes here, the more stable the company. They can withstand typically let me rephrase it. The less volatile. Typically, the larger the company, the less volatile it's going to be.
Yeah, you definitely would see higher volatility in like small cap stocks relative to large cap stocks. Every company is different, and especially in a market environment like this, like we are looking for quality companies today. So companies with strong balance sheets, good free cash flow, companies that don't need to return to financial markets to finance their operations. Those are the kind of companies that we like in this uncertain market environment.
So on that thought, the companies that don't need to go back to financial markets to finance their growth. So you have growth companies on the far right. If I'm looking at the style box, on the far right, growth, and the far left, value. Okay.
Correct.
Generally speaking, growth stocks are the ones that are going to be in need of capital, right, to continue growing. They almost reinvest all their capital back into the company. That's a typical characteristic of growth companies.
Yeah, and this is why you typically see them paying out lower dividends than value companies, or right, because they are, exactly as you said, reinvesting into the company itself. Rather,
so for growth, I'm thinking like these are more, could be tech, biotech, even some stuff in the healthcare, I guess would be biotech companies that I'm investing in this company typically because I expect this company to be worth a lot more tomorrow than it is today. That's kind of the idea. Yeah, I'm totally oversimplifying this.
Correct. Yeah, they're going to continue to grow their earnings at above, let's say, market rate.
And generally, value companies on the far left, they're companies that typically I'm not, yes, I'm investing in it because I want it to be worth more tomorrow, of course, but I'm investing in it because I'm expecting that it's going to continue, that it might be trading less expensive,
Yes,
right? It might be paying a dividend. They might be sitting on a bunch of cash, which means it's going to be more stable, generally speaking, than a growth
correct.
company that's reinvesting all of its capital.
Yeah, and so you tend to see things like PEs be lower, obviously in the value space and the growth space. You are
So PE, real quick, price to earnings. So that's the price of the stock compared to the earnings of the company on a per share basis.
right. Yeah, essentially the price that
Okay.
you're paying for a dollar
Yeah.
of earnings. You tend to see that be lower in the value space. Now, obviously, as active managers, what we are trying to do are find companies, individual companies that we think are trading below what their fair value or their future value is, and we can find those opportunities in sort of like any portion of the style box, right? On an idiosyncratic basis, but generally, like from at a category level, yes, exactly as you're describing.
And here's why I wanted to talk about the style boxes, particularly growth versus value, because a lot of the narrative that I've seen over the past 2 years, and I don't know if it's just a bias on my part, but there seems to be more conversation about growth and value over the past couple of years because we've seen some it almost seems like very distinct differences in the performance of growth versus value, more so than I remembered. Again, this might be like just recency bias on my part, but it seems like last year, man, if you were completely out of growth, you were doing great.
Yes,
This year, if you were not in growth in the beginning of the year, you got blasted.
that's right. Yeah. Over, let's say, since the financial crisis, growth has outperformed value significantly. Um, Longer term, we expect value to outperform because you're buying something for hopefully less than it's worth. But since the financial crisis, growth had outperformed significantly. 2022, that reversed in a meaningful way, and
Very
so
meaningful. Yeah.
yeah, you saw value start to outperform. And now this year, it's sort of gone back a bit the other way. But it's interesting. I mean, like, so there was a point in time. I'll take a company like Meta, which really suffered in 2022.
Mm-hmm.
I mentioned within the style box, the companies
Yeah.
we do this monthly. There was a point in time where because of how cheap Meta had gotten, it actually moved
To value.
into the value category, right?
Yeah.
And now that Meta is one of the top performing stocks this year. But it speaks to, again, right, the need to sort of maintain a reasonable level of diversification and maybe not over concentrate in just like one area of the style box for your entire portfolio.
Yeah. And that gives a lot of insight into why is my portfolio not performing like my colleague who's sitting next to me, right?
Yes.
Or why is so it really, when you get into the nuts and bolts of how the portfolio is positioned, that speaks a lot to performance. So again, predict, don't prepare. I say we're not that smart. We're not smart enough to guess where the market's going to know exactly what we should own and what we shouldn't own. I had a conversation with a client early this year. They called me out of the blue and they wanted to invest and this is a client nearing retirement. Had a conversation with a friend who was getting into AI investing. He's making thousands of dollars a day, or can't lose. And I'm like, I heard that a couple years ago with some crypto stuff. Can't lose. Like you can lose, and since March, probably a lot of that stuff is down. Would be my guess, or April. A lot of that stuff is down. But this idea of we need to diversify. Let's not jump on these trends.
Yeah, it sounds basic, but it's important to remember that the price you pay for something matters. So you can have a great asset, but at a bad price, be a bad investment.
Yeah.
And conversely, you can take maybe a not so great asset at an amazing price, can be a good investment, right? And so, this is where like the art and science meet. And this is also how markets get made, because on every side of trade are two parties that have a different view of this particular asset that they're trading. But but yeah, it also, from my seat, I deal a lot in portfolio construction and, bringing different assets together. It's a sizing issue as well, right? You can like something and you can go overweight it, but you may want to potentially temper like how much of your portfolio you kind of go into something like that. I think the AI trade, for the long term, has the power to be as transformative as the cloud,
Oh,
as transformative
yeah.
as Google search, like some of these things. But even
No
still, right?
doubt.
Like,
But here's what I find interesting, and I've done a little research into it, and you could probably speak a little bit to this, is most people don't realize it, but they have AI exposure in their portfolios. If you own any of the big names,
correct.
Apple, Microsoft, Google, Nvidia, I mean, they all have a AI play. A lot of the AI is going to be small cap, which is going to be more volatile. So you got to be real judicious in how you make those plays. And I would even say, I don't know this for sure, but this tends to be, I've tend to found this with a lot of trends lately, is a lot of the development is still private money. It's
Yes.
money that you and like a lot of the AI development is being developed by private companies that you or I or most of our listeners will never have an opportunity to invest in. And by the time it comes to the market, a lot of that crazy growth will have already happened in private equity markets.
Yeah, it's something like 60-to-1 ratio of private companies in the machine learning AI space to public companies. So
That
it's,
much. Wow.
yeah,
Okay.
yeah, yeah. But you're right. Like, if you have exposure to Microsoft is the main corporate partner of OpenAI, the folks behind ChatGPT. So you have sort of indirect exposure in that way. Google is obviously in that, Meta is in that, and then the chip makers.
Mm-hmm.
But even indirect exposure, I think it was Bill Gates who said, with respect to technology, we tend to overestimate the rate of change in the 1 or 2 year period and underestimate the rate of change in the 10-year period. This
Oh,
is the
yeah.
kind of technology I think that can be sort of just a lever on productivity and growth, like across the entire market over the next, decade. And that's where, even if you are somebody that mainly just has public equity exposure, you can still benefit from that in your portfolio. At the same time, and this is, not obviously financial advice to any individual person, you take a company like Nvidia. Yes, if we could all go back to January 1st, we would put all of our money in that. But you have to be cognizant of, you can have a great asset at an expensive price, and the bar to think that it continues to get more and more expensive over time, is maybe a little bit high.
Yeah. I like what you just said about what Bill Gates said. Now I've heard this in terms of like goal planning for us individually. We tend to overestimate what we can do in 1 year and underestimate what we can do over the long term. And actually, I want to end on that point and kind of circle back around where we started, because I think that is almost the lesson that you wish you would have learned in school, is
Yes.
that wealth is built over time,
Yes.
right?
It's the accumulation of small changes, let's say,
Mm-hmm.
over time that lead to really big results. And yes, you can, in any given year, you may or may not feel like your portfolio has done that much, and some years it really won't. But when you look back over a long period of time, especially if you've, been disciplined, in your approach to saving and your approach to investing, then you can see tremendous amounts of wealth gain.
Yeah. In fact, here's a little hack for those of you who open up, whether you're a client or not. If you open up your portfolio and you feel like, oh my gosh, the third quarter just absolutely demolished my portfolio, go look at your original investment amount. So keep your reporting. That's the thing. We talk about long-term investing. Most people get that, right? But yet we constantly want to look at a short-term event, a short-term reporting period. Look at, if you believe in long-term investing, look at your investments over a long period of time. Don't look at what they did last quarter or what they did last year, or what they did, year to date. Look what they did from inception date. Where did you start and where are you now? And it's amazing to me how that one exercise relieves so much anxiety for clients when they look at that number, and they're amazed that, I mean, they think that they're down 50% from when they first started.
Yeah, absolutely. And it's also important to recognize, like what we've experienced, let's say since the end of July, is totally normal volatility. If you look back over the last 45 years, on average, markets are up 3 out of 4 years. So like, 75% of the time on an annual basis. But on average, they experience at least the average intra-year decline. So within any year, what is the average sort of like peak to trough at any point during the year is 14%. So the fact right now that, since the end of July, markets are off maybe about 10%, again, is absolutely totally normal levels of volatility, and not at all something to be really overreacting to. I think anecdotally, in working with a lot of advisors across the country, we're hearing from, my clients are trying to move more to cash, trying to, they can get 5% now, so they're just taking all their money and doing that. And again, without being financial advice to any individual person, I think overreacting in that way can potentially be a little bit dangerous.
Yeah, I mean, go back to our historical numbers. Well, obviously, we're not in a recession, but you look at those numbers. Average 12% over the next 12 months post recession, or even more than that over 2 years. So, if you are a long-term investor, I always tell people, attach purpose to your money. Every pot of money should have purpose, right?
Yes.
Part of your portfolio might not be long-term. Okay, that's good. That might be a good place for your cash. But if you're a long-term investor and you're looking at the long-term part of your portfolio, don't let short-term events, don't let feelings impact how you position your long-term assets. Mike, this has been fun, man.
It's been great. Yeah, really appreciate the opportunity to join you and to join your listeners.
Yeah, appreciate your time and appreciate the partnership with Morningstar. Hey, listeners, if you like what you hear, please share this across social media. You can download our or subscribe, follow us wherever you listen to your podcast. Y'all, plan wisely, live confidently.